No, Jeff, I can't report a pickup here at all. In fact, it's only getting worse after what you mentioned was a terrible month for these Chinese markets. Let's give you a recap here of that 30-day performance. The Shanghai composite slipping into bear market territory, of course. That's where it sits today. Overall, the Shanghai composite dropped 8.6% today, just barely sitting above that 2,800 level. The Shenzhen composite has been weakening too. Tech-heavy index here, considered very vulnerable to the current trade tensions between the U.S. and China. The Shenzhen composite is off some 8.6% over the 30-day period. Take a closer look here at the yuan rate. This is the picture on a 30-day period. It was a terrible month, the worst month, in fact, on record. Overall, the dollar gained against the Chinese currency by about 3.4%. Taking a look at the chart for the session today, it's not getting any prettier here. The dollar is still increasing against the Chinese yuan on the session higher by about 0.3%. This has led to a lot of investors wondering whether or not weakness in the yuan could be used as a tool in the trade fight. Of course, it would spell good news for exports coming out of China, but a different story for those companies that have dollar-denominated debts. And of course, this does encourage further capital outflows, at least is the concern among Chinese officials. Let's give you a picture on the session today for the Chinese equities, too. Broadly speaking, you're looking at Asia here in the red. On the greater China markets, the Shanghai composite off 1.35%, the Shenzhen off some 0.7%. The Hong Kong market is closed for a holiday today. But aside from the trade tensions, which could worsen this week, of course, the first round of U.S. tariffs due to take place on Friday, and the response from China is expected there as well. But on the data front, some data we got out earlier in Beijing already hinting that perhaps these tensions are having an impact when it comes to actual fundamentals. When you look at the Caixin manufacturing survey that was out, manufacturing did slip just slightly. That was broadly in line with expectations, but it was the new export orders that were worse than forecast, leaving many to wonder whether or not we are already starting to see some of an impact here, because the new export orders themselves did contract for the third straight month and the most in 2 years as well. But it's not just China feeling the brunt of the selling today. The Nikkei 225, in fact, has been picking up its move to the downside ever since it came out of the lunch break. It's currently lower by just about 1.9%.
Hey everybody, it's Hadley Gamble from our new CNBC Middle East Bureau in Abu Dhabi. Thanks for stopping by. Now, to watch more, you can try one of the videos that just popped up on your screen. And don't forget to subscribe.